thank you so much, of course, for our wonderful panelists. Marc Nachmann, thank you for joining us.
Thank you for having me.
You don't really need an introduction. You run a lot of things at Goldman, and there's a lot of appetite from, I don't know whether it's new asset classes, but certainly some of the things that you put out there. Talk to me about credit. Credit is a new big thing. It's been going on for a while. How much more appetite is there out there?
Sure. I think there's a lot more appetite. I think we think the asset class can continue to grow quite substantially as it has over the last few years. And I think what private credit really means continues to expand. And so I think when people kind of read about it in the press over the last couple of years, it's really been about direct lending, which is kind of the senior secured loan part of the business. We kind of look at credit as kind of an ever-expanding universe. So you have kind of senior secured, you got mezzanine, you got hybrid capital, and the area that is probably the biggest area that is opening up is looking at private credit in the investment grade space. And so this is really looking at investment grade credit as a substitute for liquid fixed income, which is a huge universe. I mean, you think about allocation by pension funds, endowments, sovereign wealth funds, and so on to the fixed income space, it's very, very big. I think only, even assuming it's just a small fraction of that moves into a liquid private IG, will open up a huge market, and we think that that is ripe to grow as well and will be a big driver driving the overall private credit market up, all driven by the themes around bank balance sheets. Bank balance sheets certainly not expanding at the rate that the demand is out there, and so that creates the opportunity to have these investment grade illiquid credits be distributed more broadly.
So, Marc, where do you see, first of all, the biggest opportunities regionally and then sectors?
Sure. I think regionally, if you're saying with a credit perspective, I think we continue to see great opportunities in the U.S. and Europe, and we're starting to see interesting opportunities in Asia. And we over time we'll see that in the Middle East as well. But I think kind of the new space is really Asia right now. We're starting to develop that area, and we see interesting investment opportunities in that region.
What sectors? And again, I imagine it's different. Actually, the sectors in Asia are going to be a different breakout too. For example, in Europe.
It's credit. So you're trying to invest in companies that are pretty stable.
Yeah.
And you're the key to any credit strategy is minimizing defaults. And it's not really about the enterprise upside in a sense. So we're kind of focused on the more stable, durable industries.
So we're here talking, of course, about some of the opportunities out there. Where does credit sit compared to some of the other alternatives?
Sure. I mean, so very close to credit is real estate credit. Where we just closed a big fundraising for a $7 billion real estate credit fund. That is a very interesting moment in time because credit, obviously, real estate, obviously being a big topic, especially around commercial real estate across mostly U.S. and Europe. I think there are different dynamics when you go into countries like Japan or China or the Middle East. But when you look at kind of U.S. and Europe, you're still kind of in the early stages working through the interest rate cycle and what that impact has on commercial real estate. Not a lot has traded yet, but values are clearly been impacted by a 500 basis point rise in interest rate. And so a lot of people who traditionally finance real estate are full up because they're full up with exposure. So we see a lot of interesting opportunities financing new real estate based on today's value. And so that's an interesting space. I think in terms of other places to look at, secondaries are becoming a more commonly talked about theme. And I think, and kind of from a big picture perspective, when you think about how much private equity capital has been raised, and that is all sitting in various portfolios. People over time want to change their portfolio mix, have different cash flow needs and so on. And so the secondary market has developed. When you look at secondary capacity, it's a small fraction of what has been raised. And so the opportunity for secondary investments and buying LP stakes at a discount is huge. And I think it's just starting and has a very attractive risk-return profile because you're investing in secondary LP stakes of known private equity sponsors, but with portfolios that are already built. So you don't have the J curve. You can kind of look at what's in the portfolio, and you can think about what's the appropriate discount you want to have against how these portfolios are marked. So that's becoming an ever increasing asset class, and we think this is going to grow quite substantially to provide that kind of liquidity for LP stakes going forward, especially as you think about private markets continue to be bigger and bigger part of kind of asset management.
But Marc, are you surprised that, you said 500 basis points and we haven't really seen much being broken? Are you surprised about the resilience of some of the companies and also the world economy overall?
Yeah, I do think when you look at it, obviously a 500 basis point move and the speed of the move, pretty unprecedented. And it's quite interesting that not much has broken, right? I think you think back, a year ago, the regional bank crisis in the U.S. Obviously, that really happened on the heels of rates being hiked. Regional banks who had asset liability mismatches, getting into trouble. So that broke, right? We had knock-on effects with Credit Suisse and so on. But other than that, we haven't seen as much breakage. Now, one of the things that's interesting, every economy is slightly different. I think one of the things that's interesting in the U.S. is the average mortgage that U.S. household has is, I think, at 3.8% right now. So the rate on average mortgage is still below Fed funds, so not even close to where a 30-year fixed rate mortgage is. But that's because the market in the U.S. is predominantly fixed rate, and people have the mortgages that they have from a long time ago. So some of this is kind of gradually getting into the markets. I would say that companies have actually weathered it pretty well. And now I think most corporates have for a long time been very good in managing the maturity profile and have been pushing the maturity profile out. And so again, they're not getting impacted as quickly by this interest rate cycle. But you look at first quarter earnings have been pretty good. So I'd say both on the sales and the margin side, so so far so good.
So you don't worry about some distressed assets, for example, in the private market. I mean, you mentioned commercial real estate.
Yeah, I think commercial real estate in my mind still has to play out. I think that if rates are higher for longer, as now most people think, you still have the cycle to play through there. I'm not sure people have necessarily adjusted valuations to where current environments would be where you could sell. I think right now a lot of people who have commercial real estate don't have to sell. So right now there's a bit of a wait and see, and I think a lot of the lenders are willing to extend and hope for better. And I think they'll kind of get to some point where people are going to have to recognize losses. But it seems like that's still a few quarters away.
And the Fed, you're expecting a cut, right?
Yeah, I'd say what I would say is, the next move we still think we have high confidence is going to be cut, not a hike, right? I think over the last couple of weeks, people started talking about is there a possibility of a hike, and I think Powell last week made it pretty clear that that didn't look likely. And so we still expect there to be a cut, and I think when you look at our economists, they still have 1 to 2 cuts for this year baked in. I think we'll have to see. I think it'll be very, very data dependent. This week is going to be important in terms of Wednesday's CPI and retail sales number. We'll have, I think, 3 data points on CPI pre the July meeting, and so the Fed's going to have to see if you get 3 kind of improving inflation prints, you could see a cut in July. If you don't, they'll kind of push it off.
Are clients actually behaving differently than they used to? What are they asking of you in this raising environment?
Look, I think interest rates, inflation is a big topic that all our clients want to talk about. I'd say you have seen, back to the original topic, you have seen a good amount of shift and focus on private credit across people's portfolios. I think it took a bit of time early on for people to figure out where does private credit fit. Right. Is private credit a private equity substitute? Is private credit a fixed income substitute? And people have to figure out where that sits in their
and where do you put it?
Look, the way I think about it, I think it's really a fixed income substitute. Okay. I think it's it's a very, very different risk return profile than private equity. So I think I kind of put it into the kind of fixed income bucket kind of overall.
But one of the questions is actually valuations, right, in the space. Do you worry about valuations and actually, again, if not a mismatch now, maybe a mismatch in the next couple of quarters?
Look, I think what I'd say is the good news about any deals you do now, you have the benefit of having had the rate cycle, and so the deals that you do now are based on you value companies based on today's interest rate environment, and so new deals I feel pretty good about in terms of lending to new deals, loan to value in new deals, and same on the real estate side.
But I think there was a chairman of European bank, whipping up a storm saying, look, there's a dangerous bubble in private credit.
Yeah. I was on a panel with him the other day.
Do you think he was talking about specific kind of well-known factors? Or
yeah, look, I think there is there's obviously been a lot of growth in private credit, and now it's still a small fraction of the overall market. I think what I would say is there's something healthy about credit being distributed across all these funds, right? And so when you think about from a systemic risk perspective, even if you would have an increasing amount of defaults, what ends up happening is people who invested in private credit funds will make lower returns, right? And that's where that is. I think the danger always, if the whole mechanism is through the bank system and banks have default on their balance sheet, there are other things that can happen to banks that is more problematic. So I actually think from a stability perspective, I think it's actually a good thing to have this broad private credit spectrum out there. I'd say one of the things that I worry about is that over the past 10 years or so, we've been living in such a benign environment that there has been no defaults. Yeah. And so I think anybody who managed private credit had pretty much a good track record. And you couldn't really distinguish people who did a really good fundamental job from people who didn't do a good fundamental job. In fact, you could argue the opposite. You could argue that people who took more risk, even if the credit wasn't that good, did well because there were no defaults. So the more risk you took, the better you look. I'd say that my guess is that over the next 5 to 10 years, we're going to not be in as good of an economic environment and certainly not as benign of an environment. So you'll see much more dispersion amongst returns, and so that'll lead to people finding out who's a good investor, who's not, and who's taking too much risk.
So, but you can't tell. Can you start telling that now?
I think you can start telling. There's some signs in some of the markets. So, in European credit, you've seen a handful of debt for equity exchanges where people swap their credit into the equity because the companies couldn't withstand the amount of leverage they had on them. And so you start seeing that. You can kind of see who has more of those in their portfolio, and so you can kind of start using that as in judgments. I think every manager will have their own way of how to look at their portfolios and how they judge where their credits are. But I think as an investor, as you look at it, one easy fact to look at is definitely defaults, and certainly debt for equity exchanges are kind of early telltale signs that something's not going well.
Marc, liquidity, right, is always a concern. Actually, investing in all alternatives. How do you build a portfolio around that?
Yeah, I think that's right. And one of the tricky things in alternatives is, how do you think about the J curve in drawdown funds in terms of how you invest? What do you do? Do you set aside day one 100% of what you commit, or how do you manage it? And I think most large investors have kind of a balanced approach to it. I think interestingly, if you look at private equity outperforms the market. But when you look at private equity and day one, you put 100% of your cash commitment into cash, you may not outperform the market because of the J curve that it takes. And so you have to really think about it. I think one of the things that gets tricky on liquidity management has been that DPI or distributions have lagged what people projected over the last couple of years, and so that's one of the issues that's creating the secondary market to become interesting, because investors allocated more to private assets based on an assumption of cash returns over time, and then using those to make up for their commitments. As those cash returns have slowed over the last couple of years, that's what sometimes creates the need to sell secondary LP stakes.
But overall, you've seen more of an interest from ultra high net worth individuals to actually be invested in alternatives.
Yeah. I think it's interesting. We do an annual survey of the family offices that we work with in our wealth business, and we continue to see the percentage of alternatives ratchet up in terms of their portfolio, in terms of and we see family offices now thinking about target allocation as high as 40% to alternatives.
Talk to me about opportunities in the region.
Sure. Yeah, I think that we spent the whole day here, and you've had panels with a number of the leaders in the region here. There's obviously incredible economic growth here. You have a very stable region across a number of the key countries here, who have pretty consistent policies around economic growth. And I'd say as kind of a backdrop, the region right now, the Middle East makes up about 7% of the MSCI EM index. We estimate that to go up to 10% over the next 24 months or so. So I think at 10% it's going to be a very big weight in the index, and I think international investors are going to have to pay more attention to the region. I think they'll find a region with good stability in terms of leadership, as well as interesting economic growth. So we think there's going to be more investment from international investors into the region, and we're building a product setup to help people access the market.
And is that also basically sovereign wealth funds also reinvesting in the region and propping up assets?
I think that's right. I think the existing sovereign wealth funds are obviously investing in the region, but I think we also see international sovereign wealth funds looking in the region here and viewing it as part of their portfolio allocation as an interesting place to be.
I mean, we saw plans from Qatar, Saudi Arabia, UAE. Does it make a difference who comes up on top in terms of international financial center?
I don't say. I think in some sense you got to look at the region overall, and I think the overall region will grow in importance to international investors. And so I think I think one of the keys to continued growth in the region will be actually this buildup of the capital markets. Yeah. So I think you have a capital markets that's right now $4 trillion in the region. A large part of that is on the Saudi Stock Exchange. Obviously, a big part of that is Aramco. But I think you have 100 IPOs in backlog right now in the region. I think if they all come to market and the market cap of the region expands, I think it'll be easier to invest in the region. I think that'll help the overall ecosystem in the region to continue to grow.
And so, is Goldman investing in the region?
Yes. Yeah, we're actively investing in the region. We have active trading business in the region. We're one of the top international market makers on the equity exchanges here, and we're getting ready to launch investing strategies in the region as well.
Marc, thank you so much. Marc Nachmann, they're joining us today for a great conversation on credit and some of the alternatives. Thank you, Marc. Thank you.